Next up, let's take a look at how to combine metrics. So combining metrics can be useful for further in-depth analysis of a coin project and comparisons. So let's say you had access to the number of active wallets holding a coin project at a given time. You could use that number to find the percentage of total wallet addresses that hold the coin. So this would be the representation of investor interest. And you can also find the average holdings, where you could divide the market cap of the coin divided by the number of wallets, active wallets in holding that coin itself. So this can give insight on the average investor of the project and give you an estimate of possible average amount held in each coin as well. Now with that, you can start to create ratios out of multiple metrics, and this can facilitate comparisons between two or more coins with contrasting figures, whether that's contrasting market caps, contrasting transaction volumes. Now we can start to compare and utilize these different metrics and compare and contrast each of these different coins, regardless of their size or categorization regarding large cap or small cap. So here are some comparisons. These are imaginary coins. Let's say we have coin 1 and coin 2, and we see four different metrics. We see market capitalization, transaction count in the past 6 months, the average transaction volume in the past 6 months, and the number of active addresses in the past 6 months. Here we see coin 1 has a market capitalization of 100 million. This is contrasted by coin 2, which has a $5 million market cap. So we could say coin 1 has a larger market cap than coin 2, a significantly larger amount. There's a larger amount of capital invested into this project. In terms of transaction count, we see that coin 1 has 20 million transactions in the past 6 months, whereas coin 2 has 40 million transactions in the past 6 months. So while coin 1 may have more capital invested, it may have a larger market capitalization than coin 2 has a higher transaction count. This is seeing much more use compared to coin 1. In terms of average transaction volume, in the past 6 months, coin 1 only has an average transaction volume of about $50, whereas coin 2 has a $100 average transaction volume. So not only does coin 2 see a higher overall amount of transactions, it also is seeing higher transacted volume per transaction as well. It's actually double the average compared to coin 1. So there's much more use and much more capital being transacted using coin 2. And finally, active addresses in the past 6 months. Coin 1 has 30,000 active addresses in the past 6 months recorded, whereas coin 2 only has 2,000. So this gives us a much bigger perspective of the differences between these two coins. We see while coin 2 does have a higher amount of transactions and it's seeing a higher transacted volume per transaction, higher average, there are overall less active addresses. So we could infer that this could be a lower amount of individual users. Now, there's no way to know for sure the amount of individual users using each one of these two coins. Here we see active addresses, which is just a representation of the individual average, individual address, the individual wallet. One person could have multiple wallets or multiple active addresses. So while this metric is not necessarily perfect or indicative of the total amount of active users, while this metric is not necessarily completely indicative of the total amount of users using a coin, it is useful for comparison reasons. We see a higher number of active addresses, so we could we could say and could theorize that there are more individual users based using Coin One based on the much higher active address count. The next metric we'll take a look at is the network value to transactions ratio, or NVT. So network value to transaction ratio is similar to traditional price to earnings ratios that divide an asset's market capitalization by the daily transaction volume. Daily transaction functions as a replacement for earnings, as it can represent inherent value of a coin through usage. The more use and volume generated in the network, the more value the overall project has. Essentially, more people are using it. We're gauging that metric. The more transactions, the more volume generated within the metric as user interest. Now, if the market cap of a coin increases while its daily transaction volume falls, that could be indicative of the asset entering a speculative bubble where prices rise without a matched increase in use or value. Essentially, the speculation of the asset's price has gone up, but the actual use has gone down. This works in reverse as well, where if we see a coin's price stay the same or possibly decrease while the daily transaction volume increases, it could be seen as a buying opportunity where the value could correct and could increase to match the increased transaction volume. Once again, we're using the overall transaction volume, the amount of transactions, as a metric to gauge overall use of the coin project or overall interest within that particular currency. The higher this ratio is, the more likely that the asset is in a bubble. So this can generally be seen when the NVT, the network value to transactions ratio, is above 90. Now, decreasing ratios indicates that the coin project is becoming less overvalued. So here's an example of NVT. Once again, this is Bitcoin. The price of Bitcoin in the green line chart, and the NVT, network value to transaction ratio, and this is including transaction volume of Bitcoin. This is in pink. So here we see multiple different periods of Bitcoin's price action. Here is the first initial half of the cycle of the 2021 cycle, essentially. Bitcoin reaching these newer highs in January, February, March, and April, whereas we do see the network ratio with transaction volume overall increasing as well, reaching new highs. Here we see overall higher highs, higher lows generally. Now, while there were corrections, we do see the network transaction volume, overall transacted value decreasing, correlating with Bitcoin's price drop in May. There was a sudden increase and sudden pickup with the network transaction volume as well. This could also be correlated with the Chinese Bitcoin mining ban. Before the ban in May 2021, China was responsible for the majority of Bitcoin mining and Bitcoin mining facilities and miners operating on the network. After the relocation and resetting up, we do see a fair bit of reset and returns of transacted volume. We do see a gradual increase. Here we see a divergence where network transacted volume and value is increasing. We're seeing higher highs, higher lows throughout May, June, July, but the price is decreasing. So this could have been used as a metric to indicate that this was a possible good time to invest because of this divergence. We're seeing transactions increasing, the network value per transaction increasing, whereas the price is decreasing. Finally, we do see The opposite happened here, where we see price increasing, generally increasing from July, August, September, October, November, reaching new highs of about 69,000, depending on the exchange, higher highs, higher lows. We do see the network transacted volume and transacted value decreasing. There's less transactions on the network overall, whereas price is going up. So this was a bit of an indication that we were entering a speculative bubble, right? The prices continue to go up, but the actual usage of the network was decreasing over time. Lower high, lower high, lower high, and overall lower lows. Here's the same chart with Ethereum, and this essentially follows most of the same principle, where we do see here in April, massive spike in Ethereum's valuation to about 4,000 per Ethereum. And while this price is going up, we do see the overall NVT ratio decreasing. This is another divergence. Overall, lower highs, lower lows into late April into May. Once again, the price would correct and would follow suit. We do see a spike in overall transaction volume and NVT ratio. This whole area could be mainly attributed to the explosion of the DeFi sector, and especially with the increasing adoption of NFTs and overall growing interest in NFTs, where more people are actually using Ethereum to purchase NFTs, purchase digital assets, and not just hoarding it or holding on to it as they were previously in previous cycles and also earlier in the year. Here we do see a correlation. Overall NVT ratio, the pink lines, increasing, higher levels of this ratio, overall network value and transaction volume, price increasing along with it. Now, while the price of Ethereum is dropping so far based on the data that we have received from Santiment, we do see a general increase, particular going into December, of NVT ratio. Particularly, we do see a little bit of a decrease going into January, but we'll have to see for the updated metrics to give a clearer picture on how this is resulting and how this has possibly affected the January valuations that we're seeing today. Finally, here we see Cardano. The next metric we'll take a look at is market value to realized value ratio, or MVRV. So market value is the same as the market cap of a coin, which once again is the total supply multiplied by the current market price. Realized value is similar, but this accounts for coins lost in dormant wallets or inaccessible wallets, essentially lost coins that can't be accessed, coins that have not been moved off an address or off an wallet for maybe 6, 7, 8, 9, 10 years, maybe since 2009, coins that are just lost. Coins in these wallets are not valued using current market prices. Instead, for example, a Bitcoin lost in a wallet since February 2016 is only valued at about $400 per Bitcoin. This is the price that they paid for Bitcoin at that time. The Bitcoin in that wallet would not be evaluated using current day prices of about $30,000, $35,000, depending on the price of Bitcoin. Now, the MVRV is the market cap divided by the realized cap. So high ratios, such as 3.7 or higher, could suggest that the asset is overvalued and may be due for a correction. Now, if the MVRV is low, under 1 for example, then it could be determined that the asset is undervalued. Here's an example of Bitcoin using a chart provided by Santiment. The price of Bitcoin in the green line and the MVRV ratio in pink. So here we see multiple instances of the price of Bitcoin essentially increasing, and then overall the MVRV increasing as well. So this could be interpreted as a top signal, particularly in this first top in February, where the MVRV ratio hit a high of 7.75. Selling at this point, while may not necessarily, may have missed this top area, the extreme high, this 64K observed in April, overall it was a sign, an indication that this asset, Bitcoin, was in a speculative bubble for this particular cycle, essentially telling you, hey, the top is either here or it's coming. This was one of many warning signs. Overall, as the price of Bitcoin fell into May and into June and late July, we do see that bottom of about 28K, 29K. We also see the MVRV ratio bottom out as well, reaching a low of about 1.145. That's another indication. Once again, reaching 1 or falling below 1 could be interpreted as an indication that the asset is undervalued and could present a buying opportunity. In this particular instance, this was correct. And this correlated with the exact bottom of this Bitcoin downtrend as well. Looking forward, here we see in October, late October, early November 2021, we do see Bitcoin reach new highs of about 65 and finally about 69K. Once again, the MVRV ratio producing extreme highs, once again, going beyond the 3.7 overvaluation level that we spoke about before. And what's interesting here is we do actually see a divergence. Price is going higher, it's producing a higher high, higher lows, and the MVRV ratio producing a lower high. So while price is going up, this is actually going down. This was an indication that price was overvalued and would eventually fall as well.